Hello and welcome to this series of YouTube videos all on financial ratios, this notoriously difficult part of the HSC course. In order for you to get the most out of this set of videos, I'm going to ask you to have on hand your phone or a calculator, something to calculate the ratios. Grab a pad and make sure you get a pen for writing this down, because I'm going to ask you to pause the video at different points in time, do the calculation, press play, and then you can see me give you the answer and you can check to see how you did. Alright, so obviously this one's on the liquidity ratio. The liquidity ratio has two other names too. It's called the current ratio, it's called the working capital ratio. It can be equally referred to any of these names. You need to be across each of those. The liquidity ratio is really important because I'm yet to see an HSC paper that doesn't have it in it. Every single HSC paper I can recall has a question on this. The other ratios not so much, but certainly this one, you need to know it. Okay, so what is the actual ratio? It's current assets over current liabilities. The current asset, as you would already know, are those things which the business intends to turn back into cash, into its liquid form within 12 months, and current liabilities are those things in which it plans to pay off within 12 months. Let's run through. We got 5 grand, we got over 25 grand. So the current asset is obviously 5 grand. We're going to divide that by 25 grand, and that's going to equal 0.2, which is 20 cents. So it's 20 cents to every dollar of liability. We express this as a ratio. So we have exactly 20 cents of assets to of current asset to every dollar of current liability. Alright, we'll come back to whether or not that's a good thing or not, but right now let's talk about how we go about answering ratios. The first thing you need to do is calculate it. Back in the bad old days, you used to have to memorize, or students used to have to memorize all 7 ratios formulas off by heart. Then they'd have to memorize other details we're about to talk about. But these days they're printing it. Here, once you get your calculated number, you then need to make a comparison. Is the number you've got a healthy number? Is it a sick number? We'll talk about how you do that in a second. And then lastly, you need to make a recommendation. Generally, the numbers you get are sick, and it gives you room for what the business should do to improve the situation for the business. Okay, so when you calculate it, you're lucky. The formulas are printed on the page. So don't stress about it. Now, depending on when you're watching this, you should check this with your business studies teacher, even ring the board of studies, but at the moment, they're printing the formula. The only other thing you need to bear in mind is make sure you know where on the financial statement to look. Do you have to look on the revenue statement? Do you have to look on the balance sheet? Which part do you have to look at? You need to know that. Okay. Now, when you make your comparison, you need to decide whether the number you've got is healthy or sick. Okay? And to do that, you need to figure out whether or not the number is worse than an industry standard, or is it better or worse than the last year's results, or is it what it should be? Working from your head and memorizing what you've studied, is this a healthy level for it to be at? Once you've done that, you then need to make a recommendation. What action should the business take? And as I said, most of the time the number's 6, so you're recommending them to take action to fix that problem. Are you recommending them use a factoring strategy, increase sales, reduce expenses, contribute more of their personal cash, blah, blah, blah. Even if the number is a healthy number, you can say that even though the business is doing well, if the number was sick, then they could, blah, blah, blah. You outline the things, the actions they could take. This means that, let's say that you have made a mistake with your calculation and you calculated a healthy number when it should have been a sick number. You can still pick up marks on your recommendation. So say, okay, you've lost marks for getting that right, but you've still suggested an appropriate course of action when there's a liquidity issue or whatever issue the business might find. Okay, we're going to fly through this really quickly. Obviously, it's current ratio. That's the formula. It talks about the liquidity situation. How much cash does a business have on hand to meet the short-term expenses? The healthy level, 2 to 1 or 1.5 to 1. Different textbooks talk about this differently. You should always definitely have more assets than you have liability. But this is a bit of a sticking point, or there's a bit of debate around exactly what it should be. But 1.5 is generally okay, and 2 is you're in quite a strong position, obviously. With your strategies, emergency overdraft is not an answer to this. That would be simply adding to your current liability burden. But factoring is an option. You can sell non-current assets and pay off your current liability. You could only contribute more cash to the business. There's these options. Anything to get more cash around to push off those liabilities or those current liabilities is a strategy that needs to be taken. Okay, let's run an example really quickly. Here we have current assets, bang. Down here we have current, we have current liabilities. Okay, so the first number is obviously 16,000 current asset, and then we're going to divide that by the current liability, which is 20,000. That gives us 0.8. That means that for every dollar of liability, we have 0.8 or 80 cents of asset. Is this healthy or sick? Think about it. 1.2, 1.5 or 2 to 1 is the best option. So clearly this business is sick. So this business needs to do something. They could consider factoring. They could consider selling off non-current assets and paying down liabilities. Okay, with this one I'm going to ask you to grab your pen and pad and your calculator, because I'm going to ask you to calculate this one yourself. So press pause. Okay, and we're back. Hopefully you calculated that. So the current asset is $67,000, and now we're going to move down to the current liability. Bam, divide 20,000, which gives us 3.35 current asset. That's $3.35 for every current liability. Is that healthy or sick? It's healthy. It has to be. So in fact, the only issue you could say is it's a little too good. They seem to have a lot of money kicking around here, which they could use. They've really loaded up on the inventory. They have a large cash reserve. That's money you probably could put into other things. If you've got money kicking around, maybe you could invest in some non-current assets or whatever. But it's fundamentally a good liquidity situation to be in. Okay, let's try this again. For conform clothing, press pause. Let's go. So here the current asset is 13,200, and we're dividing it by 20,290. I'm sorry, which gives us 0.65 current asset to $1 of liability. Is this healthy or sick? Well, clearly it's sick. So we need to suggest a strategy. We can use factoring to sell receivables and pay down current liabilities, or we can also, the owner should contribute more cash, something along these lines. All right, so I hope this has been useful. If you found it useful, subscribe to the channel, leave a comment. I will write back. If you think I've calculated something or you want to ask a question, please leave something, or thumb the video if you like it, or if you don't like it, let me know. Do it that way. Thanks a lot.